Welcome to homeschool. Class is in session. Today, we're talking about interest rates. This is a big topic when it comes to getting a home loan, and we want to make sure you understand the basics. First, what is an interest rate? In simple terms, it's the cost you pay for borrowing money from a lender. Your payment is determined by three things: your interest rate, the term or length of your loan repayment period, and the amount you borrow. The reason this is important, and pay attention to this part, the lowest rate doesn't mean it's the best loan for you. I know, but hear me out. You may see a lower interest rate on a 15-year mortgage than, say, a 30-year mortgage. But because the 15-year loan is designed to be paid off in 15 years, the monthly payment is going to be higher than the 30-year loan option. So even though the 30-year mortgage option may have a higher rate, if the payment is lower, you might actually decide that that is the best option for you. Let me hit you with another example. Let's say you're presented with two interest rate options from two different lenders, both on a 30-year mortgage. But one option has added costs in the form of discount points and the other doesn't. In this case, by you paying those discount points up front, you could have the cheaper interest rate, but for the life of your loan. But you might decide that paying those points for the lower rate depletes your cash reserves too much for your comfort level. Are you following me? Good. Bottom line, don't assume lower interest rates are better. Ask questions and work together with your mortgage consultant to find the best solution for you. Okay, so what factors actually determine your rate? Well, it's a few things. Number one, your credit score can come into play here. A good credit score can often earn you a lower rate. Number two, another factor is the type of loan you're getting. See these potential loan types? All of these examples have different rates associated with them. The right kind of loan for you is going to depend on your situation. And number three, the economy. Now, I'm not an economist, but I'm also not going to stand here and pretend I have the ability to predict where mortgage interest rates are going. Here's what I can tell you. Rates change every day. Sometimes they even change multiple times a day. There are a lot of factors affecting the movement of interest rates, covering large and complex areas from institutions like the Federal Reserve to the bond market, and even global events that impact national and international financial markets. You can ask the mortgage consultant you are working with, and you can even do your own market research anytime. Hit up Google and ask the world where rates are going. You'll find tons of experts arguing on the internet all day long. Bottom line, you're going to have to make your own decision on when to enter the market and buy your first home. There's also another way you can impact interest rates, and that's with something called a buy down. Now, there are temporary buy downs and permanent buy downs that you need to understand. Simply put, a buy down is when you pay an upfront fee to lower your rate. A temporary buy down lowers your rate for a set period, while a permanent buy down lowers your rate for the life of your loan. So, let's cover the permanent buy down first, and I'll keep the math as simple as possible. Here's the basics. Your lender can show you the cost of a permanent buy down. Once you know the cost, you want to figure out what is called the recoup period. You might want to write this next part down. Here's an example. Let's say, for numbers' sake, you're applying for a $100,000 30-year mortgage, and the available market rate today, I'm making this up, is 6.125%. That hypothetical mortgage payment would be $607.61 per month. Now, let's say your mortgage professional tells you that in order to get a 5.5% rate, it would cost you 1 point or 1% of the loan amount. That 1%, for easy math, would be $1,000. And your new forever mortgage payment would be $567.79. Here's how you find the recoup point. The payment savings from the 6.125% mortgage of $607.61 to the 5.5% savings of $567.79 is, ding ding math, $39.82. When we divide $39.82 into the upfront discount point cost of $1,000, we can see that it will take 39.8 months of payments before you save back that $1,000. This is the recoup period. So, when exactly would this be a good decision for you? Well, if the additional upfront $1,000 cost is comfortably affordable for you, and you plan to live in the new house for at least 39.8, let's say 40 months, this might be a great decision for you. Every month after that of payments is savings directly for you. Now, let's move on to temporary buydowns. These come in many forms, but the two most common are 1.0 and 2.10 buydowns. Let's start with the 1.0. This temp buydown means for the first year of your mortgage, your effective interest rate will be 1% lower than your permanent rate. Then, in year 2, the temporary buydown will be done and you'll be at your permanent rate. The 2.10, sometimes just called a 2.1, means that in year 1, your effective interest rate will be 2% below your permanent rate. Then in year 2, your effective rate will be 1% below your permanent rate. And in year 3, you got it, you'll be at your permanent rate. So why would you choose a temporary buydown over a permanent buydown? Well, it depends. A common situation is someone who knows they're moving soon, like in 2 to 3 years. Another is when the seller is paying for the temp buydown. Win-win. Bottom line, buydowns can lower your monthly payments, but there's gonna be more money required upfront. Everyone's situation is unique. Make sure to do the math. Ask the questions, and you'll make the right call. Remember, you don't have to tackle this alone. And that's it. See, I told you it would be quick. We don't do mortgage lectures here. We just drop little nuggets of wisdom so you can really know what's going on. Thanks for hanging with me today. Class dismissed.